All right. So good morning. We want to look at what withholding tax is about. Withholding tax. Okay. So you've been hearing withholding tax, withholding tax. What it is about? What is it? We will look at it, and practically, I will bring up the return and see how you feel it. Because tax is a practical course. How you go around it and fill it in your offices if you're asked to do so. All right. Very easy. So let's look at what withholding tax is about. All right, the word is withholding. And so what we want to look at is what actually the withholding tax, the meaning of withholding tax, and the types of withholding tax, and the tax rates pertaining to each withholding tax. Uh, that is what we want to look at. All right. So the practical case is that when you buy, let's say you buy goods or services or what we call works, which we will look at them later. So you contacted somebody, you bought something from the person, you ask the person to render a service to your works. These are things of constructive nature. When the work is done, what happens is that the next thing is payment. Payment. All right. So that is what normally happens when you buy the thing. The next thing is that you pay. Okay. Now, the law actually looks at this in terms of an investment, because we all know that when you do something in employment, it is taxed under employment easy. Business is also easy, but investment, those kind of one-time things. But let me strike here that when an investment becomes repetitive, it then turns into a business. All right. So that is how the law wants us to look at it. So in any case, let's represent this thing by the buyer, by what we call a person. A person. Now, the person, when the law says a person, we all know that it talks about an entity and an individual. So we are looking at an individual or an entity who has bought these things here, or contacted for a service to be rendered. Once it is done, the next thing you see is that it's either the entity or the individual, they make payment. All right. So what is then is withholding tax in this? When we look at withholding tax, we are looking at this level where the payment is happening. Okay, when the payment is happening. So under normal circumstance, you are supposed to pay the person. The person will go and prepare his account or whatever it is. Then the person will now go and pay tax. So the payment here, we are looking at what goes into the third party. Okay, so all right, the company or a person is now buying from or doing business with this man. Now, at the time of payment, that is where the withholding tax comes in. So the withholding tax is a tax that is deducted at source. All right. Now, not everybody, the law says that it is deducted by an authorized person, or what we call a withholding tax agent. So a withholding tax agent. All right. So you deduct at source, and at that point, you now go and pay to GRA. So the authorized person here, which we call a withholding tax agent, the law says this individual is out. An individual cannot be a withholding tax agent. So it refers to this one, the authorized persons as the withholding tax agent, normally entities, especially those who pay tax under quarterly installment, and permanent establishment. All right. Okay, so that is what we are talking about. That is what we are talking about. Of course, you have to have some kind of permanency for a time. So that is it. Now, we have two types of withholding tax agent. Of course, the two parties here involved, this side, we will call it the withholding agent. Then this one will be the one that we call what? The withholdee. All right, the withholdee. Okay, so that these are the terms that you need to know. All right, then quickly let's look at the classification or the types, what we call, so when it comes to withholding, we are looking at, and don't forget, these are what you are deducting the withholding or the payment on these ones. So we will look at the practice note, what the Commissioner General has said about it. But before that, I just want to do this classification of what we call a final withholding tax and non-final withholding tax. All right, these are classification that has to be known. Okay, so when we talk about a final withholding tax, what we are saying is that once you deduct the withholding tax, there are some, if you, let's say, if you buy these things and you are paying and you are deducting withholding tax, the final withholding tax is the withholding that you will deduct satisfy all the tax obligations. Of the taxpayer, i.e. the withholdee. What do we mean by that? It means that if, let's say, a company A buys goods from company B, all right, and company A now deducts the withholding tax on that particular good. Okay, so let me be more specific in this example and say maybe you bought something 5,000. All right. Now, if you bought it 5,000 and let's say you deduct withholding, let's say the withholding rate is 3%. So when you deduct 3% of the 5,000, you get 150. So this 150, company A, who is the withholding tax agent, will remit it to GRA. And if this 150 is a final withholding tax, then what it means is that company B will never pay tax on this transaction anymore. All right. The tax that he has paid, which has been deducted by company A and paid to GRA, is the final withholding tax. All right. So that is what we mean by that. So we are saying that in that case, this income for company B will not be included in the assessable income of company B. This is very important because when we get to employment income, it will pop up. So I need you to understand from here. So what happens is that, let's say Mr. Ansan let's say it's an accountant, okay, in a company A. You see, and Mr. Ansan at the same time, let's say render service, part-time service. All right, depending on whether part-time service. So you realize that this part is an employment income. All right, and this part, it qualifies for, of course, whether employment income or whatever income that we are receiving. I always say that even payee is a withholding tax because it is deducted as source. All right, it's deducted as source, like we said, and the company is the withholding tax agent, so you will deduct it from the employee. All right, but if this part-time is here, and you are supposed to deduct, let's say, 10% of the money of the part-time, and it is final. Let's say the money is 1,000, so you deduct 100. Okay, so and it is final. That 1,000 will never be added to the income of Mr. Ansan when you are doing his assessable income. So you know, assessable income is income from employment, income from business, and income from investment. Because I've already paid the final tax on this one, that income will not be included in my assessable income. All right, because it is final, just because it's final. All right. Now, on the other hand, if it is not final, then it means that the tax that you have deducted, the withholding tax deducted, does not satisfy the tax obligation. What does that mean? It means that in this case, for example, you have to include this 5,000 as part of the assessable income. So the 5,000 will be added. Then the tax of 150, once you finish the assessable income and you do the chargeable income and you determine the tax that is charged, the 150 that he has paid already will be subtracted from the tax that is chargeable now. All right, so that is what you need to know. So that is the difference. So when it is final, you don't bring it in the assessable income at all. But when it is not final, you have to bring the gross amount. Don't forget. So this one, for example, I think the net would have been 4,8, 4,8. Is it 4? What is that? So you have, let's see, you have 5,000. Then you take away the 450. You are having like it's 150 rather. So 5,000, you take 150. That's what we had. So it's 4,8, I think 50. So that is what we have. Now, if they give you this in the question, it means that since it is, and you are treating it in the case of non-final, you have to gross this money up back to the 5,000 and include it in the assessable income. Just be careful. And that is what they used to trick the students. So you have to understand whether it's final or not final. Because if it is not final and the question gives you this, they said that, okay, he has another income and this is the net. Net means that they've already deducted the tax. Because it is not final, you will need the gross. So you have to gross this thing up. And as for grossing this thing up, you have to take the 4,850, and since the tax rate is 3%, you have to gross it up by, if you take this, you have to gross this one by 0.97 because the tax rate was 3%. I think you get your 5,000. So this one is simply telling you that this net was after the 3%. And therefore, if I want the full percentage, then I can gross it up by this 0.93, because this 4850 is representing 3% out of the 100. So when you gross it up like that, you get your 5,000, and you add this 5,000 to the accessible income. But when you finish everything, you've known the chargeable income, and you now know the tax that is supposed to be paid. So let's say, for example, at the end of the day, this was the full accessible income, and when you less some reliefs of the person, you had, like, let's say 3,000 chargeable income. All right. And when you apply the graduated tax scheme, all right, let's say at the end of the day, you saw that the tax liability is, let's say, let me give it like 200 Ghana cedis. So this is now the tax that is supposed to be paid in total by the person. But we know that he has already paid the 150. So therefore, you take the 150. So therefore, the tax liability now becomes what? 50. So that is how you differentiate between the final and the non-final withholding tax. Now, let's go to the practice note, what I'm going to use to teach withholding tax. Let's pick some things from there. So don't forget, in tax administration, we learned about the practice note. And what was a practice note? The practice note is a Commissioner General stand, all right, viewpoint of how the tax law should be viewed at. And the advantages, all right, are always outlined in the practice notes. So I know we've dealt with it, but this is the purpose of a practice note. The practice note is to provide direction and guidance to officers of Ghana Revenue Authority, tax practitioners, consultants, and taxpayers, and the general public on the acceptable treatment on what withholding taxes. And so for direction and guidance, and also to achieve consistency in tax administration. So these are the two basic purpose or advantages of withholding tax. All right, so that is something you need to. All right. So again, it also helps to address the administrative and operational challenges that may arise from the interpretation and scope of withholding tax. So that is the third thing that we talk about. All right. So now we said that it's in withholding tax is applicable on the following. We talk about investment return, and like I said, a repetitive investment activity becomes a business. All right. Then we will look at the supply of goods, service, and contract payment. What is a good? What is a service? What is a work? We will try and understand it. All right. So payment by a resident person to another resident person. We also look at payment of such to a non-resident person. Then in petroleum operations, that one I may hold on. Okay, let's deal with that. Because in petroleum operation, I normally treat it when we are doing petroleum and mining, which is an advanced tax. All right, so we may probably deal with that one over there. Now, so the branch profits, like the MTNs and all those people whose owners are not in Ghana, and when they have profit, they have to repatriate the profit to the owners, withholding tax to applies. All right. So that is that. That is that. That is that. And we are looking at this in the scope of what Income Tax Act 896. Now, what is a good? What is works? What is service? So when we talk about goods, the key thing is that we are looking at objects of every kind. All right. So including raw materials, products, and objects in solid, liquid, gaseous form, and electricity. So you see, the electricity that you go and buy is a good, not a service. All right. As well as, and this is the key, this is the part that is very crucial. I need you to understand, because this part in offices, it creates confusion. Now it says that as well as incidental to supply of goods, if the value of these incidental service do not exceed the value of the goods themselves. All right. Now it goes on to say that goods includes movable, tangible properties, thermal, electricity, energy, heating, gas, refrigeration, air conditioning, water, then, but does not include money. Money is not a good. But let me come back to this thing. So, for example, I'm buying a book, and that book is going to be printed. All right. Now, you realize that when it now comes, the person will serve you an invoice. And normally, so in the invoice, you see a mixture of the goods, the book itself, and the printing. But you see, if the person did not print it, I wouldn't have the book. That is what we call incidental services. All right. Now, so the tax law is saying that, so if the invoice come and we have the book, which is say 5,000, and they add the printing, which is let's say 500. So in all, my transaction price is 5,500. Now, so people in practical offices are confused as to, okay, so printing is a service. That is what they want to do. And some people will split it and charge probably 3% on this one. And because this one is a service, they will charge 7.5. But that is not what the law says. The law says that as well as what? A service that is incidental to the supply of the good, if the value of that incidental service does not exceed the value of the good. You realize that the printing the person did is not exceeding the value of this book. And so therefore, the law says that in this case, I'll have to treat the entire 5,500 as a good and apply what? 3%. So I know people experience this thing a lot. I've had several calls. Okay, so do I split it and all those things? If the person, I mean, is rendering both uh, the sale of the goods and with some kind of service. So far as the service cost in that job is not exceeding the value of the good itself, you are supposed to treat that incidental service also as a good. All right. I hope I've explained this thing clearly for you. All right. So the vice versa also goes to the service and also. So you have to take serious attention to this. All right. So the applicable rate for goods is 3%. All right. So please take note. I'll later deal with all the rates. All right. So that is 3%. So take note of that. But there is a caveat to that 3%, as in the limits. Okay, so we will look at that. That one too, I think I've had several conversations with people trying to understand how it took place. Now, what is a work? A work is defined to include works that are associated with construction. All right. Then reconstruction. Please, the reconstruction here, we are not talking about debt reconstruction. We are talking about a physical reconstruction, like you are rebuilding something and all those things. We are talking about demolition, repairs and renovation of a building, structure or surface, include site preparation, excavation, erection of building, erection of masts for telecommunication. I hope you know this, that poles and those things that they do for internet connections, serviceabilities. We are talking about assembly, installation of, please, this is also not municipal assembly, all right? Sometimes you have to assemble things. We are talking about installation of plants, fixing of equipment, laying of materials like blocks, all right? Decoration and finishing, all right? So polishing and all those things, and any incidental activity under a procurement contract. You see, that is where this becomes very tricky. So the law says in the context of excavation, we are talking about removal of earth, cutting, digging, scooping during construction works. Now, the same thing applies here. And this is where I used to work in an office where these things happen a lot. So it says that the work includes incidental activities under a procurement contract. So you see, you want somebody to just, I was in the petroleum sector. So, and then my sister company, which was an OMC, had a whole lot of construction activity going on. So you see, when you buy a new filling station, so let me use that one as an example. You realize that they will have to dig down and put the tank in there where the cars will pour the fuel down, the tanks. They'll pour the fuel down before they will put some machines on top. And when you go, you just slot in there. Then you fuel your car, you go. All right. But the underground, there is a tank there. Okay, so that is that. And that is where the car tankers will pour the fuel or release the fuel to. Now, the question is that, and these are practical things that happens. So you contact an engineer, and what happens is that the engineer will have to dig down, okay? And the engineer will have to buy the tank, and those calibrations has to be done, and you put it underground. All right, so that is that. Now, and we are the company. The engineer has added all these costs, and the engineer has given us the invoice. So you see that the purchase of the goods, which is the tanks and the things that he is buying, will be there. The service, that is the works, also will be there. Okay, now, so you see, this one attracts a rate of 5%, works is 5%, goods is 3%, and we know that service is 7.5%. Now, but there is a caveat. We will look at that. The thing is that when the service is more than 2,000 Ghana cedis, so if it is less than 2,000 Ghana cedis, you have to hold on the withholding tax. Now, so what happens is this. So when the person brings you the invoice, people are torn between, oh, okay, should I tax the invoice, what he gave us, and the goods that is there at 3% withholding, and also tax this one at 5% withholding? This is what the law says. Now, the same thing that apply, it says that any incidental activity under the procurement contract. So if the person had to buy certain things as part of conducting his work, it's an incidental activity. And so therefore you have to treat all those things as works and apply what? Withholding of 5%. As a matter of fact, the engineer is not the one who sells the things. The engineer is rather going to sell the thing, buy the thing. So the concept of withholding tax, if the engineer is an entity that is going to buy from a supplier, it is the onus is on the engineer, not you, the company that contacted the engineer. All right, unless you are the company, you are going to buy the things for the engineer. All right, but if you are giving the engineer the money to go and do everything, everything is incidental to the works. So therefore, the withholding tax of 5% applies, because all you know is that he has served you an invoice. That is what you are using to pay. All right, let's move on to service. What is a service? Service, we have types, and we are talking about the furnishing of labor time, all right, and effort involved in the delivery of a specific end product, all right, other than reports, which are merely incidental to the required performance. And it includes consulting, professional and technical services, but does not include employment agreements, all right, because employment agreement has its own form, which is the payee, all right. So then it also does not include collective bargaining agreements. All right, now the types of service, you see that we talked about consultancy and professional. And the law says that the payment subject to withholding tax under this act for services rendered by a recipient of the payment through the business, a business of that a business of that person or a business of any other person. Now, the key thing I want you to see is that the service fee, we are talking about the provisional, professional, sorry, the technical, and the consultancy service. All right, these are what we are looking at, but the consultancy should not be in the form of a employment, because that one employment income applies. So we are talking about scientific library, artistic training activities, as well as the activities of physicians, surgeons, lawyers, engineers, architects, surveyors, dentists, accountants, uh, auditors, and any of such professional activities. All right. So we are saying that the services are carried out by the withholdee in conducting the business, including an isolated arrangement, which is with of a business character. And we talk about technical services too. All right. A technical service, we are talking about those that are measurable physical outputs, such as drilling, mapping, aerial photography, surveying, seismic investigation. These are petroleum activities. Maintenance of facilities or plant. All these things are petroleum. All right. The drilling here we talked about, like I said, is the petroleum mining activity. Consultants, we are talking about, you are giving an intellectual and advisory service using professional skills to study and design, organize a specific project. So that is what we are talking about. So now, what we want to, here we talk about withholding operations, and it says that the act requires a resident person who pays an amount in terms of works, supply of goods and services to another person who is a resident or a non-resident with a source of the income in Ghana. You have to withhold tax. The tax rate, we will look at that. It is specified under paragraph 8 of the first schedule. All right, and you have to pay it to the Commissioner General. Now, so we are talking about withholding tax on investment return. We will look at the goods withholding tax payment to a non-resident person. We will talk about the exemptions from withholding tax and the type of payment that is included in all these. We are going to look at these things one by one. We'll talk about the source rule, the application to particular types of persons, calculation of the withholding tax amount, the procedures, and all. So let's look at withholding tax from investments. All right. And don't forget that we will be looking at this thing in terms of whether it is a final withholding tax or a non-final withholding tax. All right. And we'll also be looking at it in the eyes of whether the thing is exempt or final and final, resident and non-resident, and if it is exempt, and that is what we do. All right. So in investments, this is what we are looking at, investments. So if you receive dividend, so let's talk about dividend. And like I said, we will look at it in the form of resident person. The tax rate differs for residents and non-residents, all right? Then we talk about non-residents. All right, so a dividend uh, for a resident person is 8%. All right, a resident person is 8%, and it is final. It is final. All right. So please take note of that. But you see, all for non-resident person, everything is final, because if it is not final, you may not see the person anywhere to get the tax. So everything is final. All right, because the person will not prepare his account to you for you to deduct. All right. So that is that. So you have 8% final. All right. Then we talk about the interest. The interest. Now, the interest, it depends whether on the person receiving the interest. So if the person receiving the interest is an individual, I think I will have to, it's exempt, but I think this was amended to 1%. But let's go with, now we have uh, exempt, it's exempted from tax. Then we have, if it is a business like an entity, that one attracts 8%. And this one is non-final, which means that you have to include the money that the person received back to the assessable income. So those are the things that you need to check. Those are the things you need to check. Now we move on to lottery winning. For lottery winning, there is a threshold. And I think in 2023, as we are in there has been a small amendment on lottery now. But your exams will not be for 2023. Even though we are in 2023, the exams question will be in 2022. So you answer the question as if you are in 2022. All right. All right, let's look at the lottery winning, and that one has been spelled out here. Okay, so you see the lottery winning, what happens is, if you win a lottery, we want to treat you like, I think this one too had to be checked, because this one has been there for a very long time. Even the current one was for the minimum, it was 4,000 something. But the graduated tax system, you see, there is a minimum, and for that minimum, you cannot, if the person won the lottery at that minimum, you cannot deduct withholding tax from it. But if it exceeds the minimum, this tax-free, so it is the tax-free range. All right, the first nil, you cannot tax the person. But if it is above that, then you will have to withhold tax on the lottery winning. So the lottery winning, if it is above this one, the tax rate is 5% and it is final. Okay. And this one usually excluded the national lotteries. It excluded the national lotteries. So the one that people do outside, like what do you is it Asari original pay or those kind of lottery things that we are talking about? All right. So for natural resource payments, that one is 15% and it is non-final. It's non-final. As for rent, it depends whether the rent is residential or the rent is non-residential. Okay, so the interest too for a non-resident person is 8%. And like I said, those ones are always final, right? So I think there are other, depending on the DTA, you have some non-resident person with permanent establishment. Non-resident person with permanent establishment. We will look at those ones separately. All right. So let's just go on. So the law didn't actually make any space for a person who has won a lottery in this regard. Okay, so uh, we will chalk on that. But over here, like I said, so let's just focus on the residents. We will look at the non-residents. I'll give you the tables for that. So the rent, depending on whether it is a residential or non-residential. So if you pay rent and it's residential, and we are talking about an entity, not an individual, that one attracts 8% and it is final, all right? This one, the non-resident ones are 15%, non-final, sorry, final, all right? Then the royalties over here, royalty uh, is 15%, non-final. All right, so these are some bits of them, but we will definitely look at these things in details, but keep it in mind when we start our employment income. Some of them will pop up. All right. So I'll give you a full table of the withholding tax rate applicability, and I just try as much as possible to grasp more. All right. Okay, so we are talking about the exclusions. So we said that the tax obligation to withhold tax from returns on investment does not apply to these ones. We are talking about payment that are subject to withholding tax under employment income, to not apply to them. Payment that is made by an individual, unless that payment is made by the individual in the conduct of a business. So like I said, the individuals are not withholding tax unless he's doing it on behalf of a business. Then we are talking about interest paid to a resident resident financial institution. Okay, so if you pay an interest to a resident financial institution or payments, this one is exempt. Payments that are exempt amount to are also exempt from withholding tax. All right. So these are normally the things. So this is the residence part. So let's look quickly at them. Tax withholding tax on payment of service with the source in to a resident individual. So that is the one that we are looking at. So this is the residence part. Okay, so they've listed so allowances. So those who take allowa to a resident director, a manager, and all those things, all those fees and allowances. Please, the tax rate, the withholding tax rate applicable to this one is 20%. All right, it's 20%, and it's non-final. All right, take note of that. And part-time teaching, lecturing, examination, invigilation, like the one we are doing, we are supposed to, is 10%. I mean, and it for this one, it is final. And the thing is that if you don't deduct and you give me my payment, I can't do the withholding tax. And I assume that you have done it final, so I will not add it to my own income tax for assessment. Endorsement fee is 10% and it is final. All right. Then we have commission that you pay to a lotto receiver or a lotto agent. Lotto agents are supposed to pay 10%, but that one is non-final. Then commission to a sales or a conveyancing agent. So I used to have this situation when I was working with Prudential Life, Prudential Insurance, and the commission that they give us attracts withholding tax of 10%. That one too is non-final. I think this is insurance sale. This is the best that qualifies under what I was doing. So the same 10% non-final. All right. Then we are talking about supply for any other supply of service. Okay, so supply of service, the caveat is that the service must what? Exceed 2,000. All right, and therefore, if it does, then the rate is 7.5 and it's non-final. Please, this 2,000 is a year, so it's a year. So the whole of the year, if the service that the person is rendering to you will not exceed 2,000, then you can't. But if it will, so let's say there is a first service, that one was say 1,008. You can't deduct withholding tax from this. The next one, if in the same year the person come to render another service and that one is, let's say, 400 cedis, then it means that the guy has exceeded the 2,000, and therefore you have to charge the withholding tax on this money. So let's see what happens. So if I do 0.075% on 2,200 herein, it means that it's 165. So this one, probably you paid him all the 1,008. But as at this time, you are paying him this 400 for the second service he has done. You have to deduct the 165 from it and pay the person what? 235 cedis and remit this one to GRA. All right, so take note of that. And they said that for any other matter that may be prescribed under regulation. All right, no problem. So these are things you have to take note. It's good you keep some of these things in mind. It's examinable. All right, so please note that. Note that. If you forget anything at all, remember the part-time teaching, because that is what most people do when it comes to employment income. All right, so please remember that teaching, lecturing, examining, vigilating, and all those things is a part-time, and it attracts 10%, but it is final. All right, final means that you add it back to the assessable income. All right. And the tax that you deduct also will not reduce any tax liability. So I'm not saying that when it is final and the income is not included in the assessable income, the tax is deducted when you get your chargeable income. No, you don't do that. All right, because the income was not included. Why will you now deduct the tax from the tax liability of the person? All right, so please take note of these things. We move on, and it says that the provision requires all resident person, whether a company, trust, partnership or an individual to withhold a payment of a service fee with the source from the country. All right. But this is ambiguous here because the individual is not a withholding tax person unless you have been designated as a withholding tax person. All right. So uh, it says that note that the threshold does not apply to the above circumstances. Of course, the threshold of 2,000 only applies to the supply of service. All right, supply of service. So the others, it doesn't apply. All right, please take note of that. So we have here the withholding tax for the supply of goods and service. So you have to withhold. Please, supply of goods is what, 3%. The supply of works is 5%. Supply of service is what, 7.5. And it says that in respect of a contract, the payee and the resident where the contract exceeds 2,000 currency. I think I've already mentioned that. Withholding tax on rent income. So I told you that the rent income, the resident is what, 8%, non-resident is 15%. All right. So, but there is a caveat here we need to check, which this one is something you need to know because I've used it as a tax advice to help a company before. All right. Now, it says that a resident person who makes payment to another resident in respect of rental of a residential or non-residential shall withhold tax as investment return, and the amount shall be withheld and treated as final withholding tax. I think we've spoken about that. So residential is 8%, non-residential is 15%. Now, this is the part I need you to check. It says, however, where a resident person makes payment to another resident person conducting a business of sale or letting of residential of non-residential premises, the payment shall be treated as a payment for the supply of service. So that is that, supply of service, not as a payment of investment return. And the tax shall be withheld accordingly. The amount withheld shall be treated as tax withheld on account and not as a final withholding. So look at this carefully. This is the English, and look at it very carefully. So where a person makes payment to another resident person conducting, so this, the resident person is conducting a business for the sale. That is what the person does. Like I told you that when an investment income becomes repetitive, it is looked in the eyes of what, a business. So if a person, a resident person, is conducting a business of the sale or letting off of rental or of letting off of a residential or non-residential premise, the payment shall be treated as what? Payment of supply of service. If you're able to figure this out, it will help you a lot because we all know that under normal circumstance, residential, so if the thing is an investment return for the person, we know that that one is for a non-resident, we said it's what, 15%. But we also know that a supply of service is what, 7.5%. If you are able to figure that one out, it helps your entity a lot. And you remember this one was 8%. You're able to figure this out as a tax planning activity that the person that you are paying is conducting that thing as a what? A business of the sale and of the letting off or letting off or letting off. So see, of residential and non-residential premise. Let me help you. When you meet these things, let me just help you. So what I'm going to do is English, and therefore what I'm going to do is to help you figure out something. So when we say letting off, what does it mean? It's English. This is it. The action of what? Renting out what? A property. All right. Letting. So that is what you see here. Now let's go back to what we are doing. So if the person is what the person is doing, says that to another person conducting a business of sale or letting of residential and non-residential, then it means that what? The payment shall be treated as what? Supply of service, and not as a payment of investment return. So please, this one, you have to figure it out. All right. So that is that. And like I said, if you're able to figure this thing out, it helps your entity a lot. All right. It helps your entity a lot. Okay. This is the Commissioner General's opinion. And don't forget, we said that practice note is binding on the Commissioner General, and it is not binding on what? The taxpayer. So if you do it, you have it right. It is actually binding on the taxpayer, the Commissioner General, not on the taxpayer. And the tax shall be withheld accordingly. Okay, so you know the tax rate to apply. All right. I have benefited from it before. I remember receiving praise on that. So the tax law, it is good to have a deeper understanding of that. All right. Let's move on. Of course, so we have here, what about branch profit? We are talking about repatriation of. So if a non-resident person carries a business in Ghana through a permanent establishment, so you are somewhere, you have a business in Ghana, and who earn a repatriated profit shall pay a tax, all right, on that period. And this is a form of dividend that you have. So that one attracts a withholding tax of 8%. I think I've already mentioned that. And it says that the tax shall be withheld, and it will be a final tax on the gross amount. All right, so that is that. Where in any particular year the permanent establishment rather incurs a loss, the loss shall what be carried forward under the relevant sections of the act. That will be section 17. All right, unrelieved losses. So we said that, note that unrepatriated profit of a permanent establishment of a non-resident person is equal to the net profit after tax. All right. So please take note of that. So the profit that we are talking about is the net profit after tax. So what we mean is that if you have a company, and let's say a company, so you have profit before tax, let's say it's 10,000, or let me use 1,000. You know the tax the company has to pay, depending on the location. Let me use the marginal of 25%. So you have like what, 250. Then we have like 750. It is this money that when it is going out, you have to charge the 8%. All right. So let's see if you now do 8% times 750, then the person will have to pay a tax of 60. This is withheld and paid to the Commissioner General. All right. So this is an example for you. So the branch profit is 2 million in 2016. So this is what you have. Then it's after tax. So the branch profit is the repatriation is what, 8% of 2 million. That is what you have. This one says that XYZ Ghana branch declared a loss of what, 500,000 in 2017. XYZ submitted the returns in 2018 year of assessment in March. All right. So it means that they had a loss in 2017, but in 2018, if this is assumed that the accounting year starts from January to December. So in March, this is what they did. So this is the net profits after net profits before tax. So what you do is that this, in case depreciation is not allowed in taxation, so what you do is that you add back depreciation and you less what, this capital allowance. All right. That is on the assumption that these depreciation are already inside. All right. Already inside this. So, and the capital allowance probably is not. Because if the depreciation is not inside, then it means there's no need adding back. All right, they didn't even use it. So what we mean is that you deduct the depreciation and you rather you add back the depreciation, you rather less the capital allowance, and this is what you get. Then you less the loss they had before. All right, relief loss, the unrelieved loss. Then you get your adjusted profit. You tax your 25%. After the 25%, it is the 8%. All right, so that is that. Okay. I'll skip the petroleum activities because it is dealt with under petroleum. Okay, so that is that, and the mining. Now let's look at the payments that you make to a non-resident person. Okay, so for non-resident person, please don't forget that when we dealt with the service and the goods, we gave a caveat for 2,000 Ghana cedis. Don't forget that. Now let's look at the non-resident person. Okay, so the insurance premium of with the source in Ghana, the rate, and we are looking at final. All right, we are looking at final. The insurance here attract what, 5%. All right, the insurance premium. Then we talk about management of and technical service. You know, in these multinationals, they will have their head office outside Ghana. Sometimes they will let the IT experts come and you pay the money to the head office. All right. So all these technical service that those people will be rendering for the other party, those ones also comes with withholding tax. It comes with withholding tax. So you see, the thing is that when they come, they are coming to do the technical service for a permanent establishment. All right. Because of that, the withholding tax that is applicable for that kind of management service and things, that one attracts a withholding tax of what, 20%. And because of the, it will be non-final, the P. All right, so take note of that. Supply of goods, supply of works, all these ones are 20%. All right. Okay, but if this thing is to a permanent establishment, like I said, it will be non-final. All right. Other than that, it is final. All right. Take note of that. But you see, when it comes to the international aspect of these things, the double taxations apply. All right. All right. So, like I said, it says that where a payment is made to a non-resident from another country, which has a double taxation, the tax rate shall be the rate applicable under the DTA. All right. So, for example, if it is a UK person, I think the UK one, Ghana UK is still 20%. So that's that. All right. So a non-resident person who seeks to rely on the double taxation shall submit a certificate of residence from the competent authority that the person of that person's residence to the Commissioner General. That's simple. You just because you are non-resident, where you are, you just get a certificate that says you are resident at that place. All right. So that is that. Obligation of a resident person who enter into a contract with a non-resident person. So if you are entering a contract with a non-resident person, then you have in 30 days to inform the Commissioner General in the form of a written document or a filing, the nature of the contract, the duration, the name and postal, the total sum involved. All right. So you have to do that within 30 days. You notify the Commissioner General. All right. We know that some payments are exempt from tax. We are talking about premium that you pay to a resident insurance company. All right. So please take note of that. That is why the insurance that we pay is not subjected to withholding tax. Then payment of for sale of goods, which constitute trading stock in both the purchaser and the vendor. I think we will explain this one later. A trading stock beneath we will give some explanation. All right. Then also interest or dividend paid or credited to a holder or a member of investment of approved unit trust scheme. So these mutual funds and the trust funds, dividends paid to them because of your member of that investment that is taken by that trust is exempt from tax. Then interest paid to a resident financial institution is also exempt from tax. And payment made to a person. Yeah, so that reminds me, the interest that you pay for interest that an individual will earn from investments, that one attracts a withholding of 1%. Yeah, the law was amended, 1%. It says that payment made to a person specifically exempt from income tax law, so like the Kufuados and all those people, the ambassadors and all those payments which has been made, which has been granted exemption from withholding tax by the Commissioner General. All right. So if it's exempt, then payment, and this one is key. You will need it even in level 3. So if you are a resident company and you are paying a dividend to another resident company in Ghana, in which that resident company you are paying the dividend to owns at least what 25% of the voting power, that one too is exempt from tax. So this one is key, is a very tax planning activity. So please take note of that. Then let's look at the trading stock issue. So we said that the sale of goods constitutes a trading stock of both the vendor and the purchaser if the goods are the same goods that are being sold by the purchaser in the distribution of the product. So let's look at this example for clarity. So ABC Limited purchases bag of sugar from a wholesaler, XYZ, for retail to the general public. You see, it is the same sugar it bought that it is also selling to the general public. And therefore, there will be no withholding tax because the sugar is a trading stock. All right. So it's a trading stock to both ABC. So the general public who bought that from ABC, from XYZ, will not deduct withholding tax. All right. Sorry, so XYZ herein will not deduct withholding tax from ABC. All right, so there will be no withholding tax because it is a trading stock in both the hands of this person and this person. So if an OMC, oil marketing, buys from a BDC, because it is going to sell it to the general public, it cannot deduct withholding tax unless it is going to use it. We have ABC Limited purchase bags of rice from XYZ to use for raw material in the production of a final product, sweet drink. You see, this one, it is not selling as a ball, all right, and non-alcoholic beverage. So ABC will be required to withhold tax when making the payments, all right, to XYZ Limited because the two companies do not trade the same good, all right. So please take note of this. So if you buy from somebody the same thing you are going to sell out, then you cannot deduct withholding tax. But if you are going to use it, then you can. So it's ABC Limited produces and sells alcoholic beverage, whereas XYZ sells sugar. So it's not the same. I've already spoken about the threshold for goods, which is 2,000. All right. So that one does not attract. Two or more contracts within the same year is in respect of the same good works is to be treated as a single contract. All right. So like I showed you the additions. All right. So this is the illustration. So below you have first contract was costing what? 1,000. So you can decide not to. Second contract is 900. Still, it's not up to 2,000. Then the same contract you have. So the key bit is the same thing. The same thing. Like I said, these things, if you understand, so please look at this very well. Below is the contract awarded to MNB Stationery. So that is what the person is going to do. So the first supply was 900, which so all these things will not attract, but you see together I think it's 2,800. So in the end, so like I said, this one will not attract, plus this, it will not attract. Then when this one comes in, it now gets to this. So since it has exceeded, the cumulative amount subjected to withholding tax. All right. And please take note, it's on the cumulative, not the 900. Right. So I think I've illustrated that already. Then we have payment. We say a payment has a source in Ghana where the payment is attributed to a supply of goods that was rendered in Ghana, regardless of the place of payment. So far as the job is done in Ghana, regardless of where you are paying the person from, it is subjected to withholding tax. Okay, so please take note of that. So far as the job was done in Ghana. So if, let's say, let me give you an example. So company A is paying company B. Now, where was the service rendered? If it is in Ghana, And let's say company A has an account in UK, and this one is also in UK. If company A is paying from the account in UK to this company UK account, it still attracts withholding tax because the purpose for which the payment is being made is something that was done in Ghana. All right, so please take note of that. That is what we mean by the source. All right, take note of that. So yes, it says that the payment of work that is sourced in Ghana is attributed to work that is undertaken in Ghana, regardless of the payment. Work is undertaken in Ghana, where either the activities is carried out in Ghana or the payer is a government of Ghana, including all agencies, except specifically exempt. All right. So far as it's rendered in the country, that is that. Persons required to withhold. A withholding tax deductions apply to payments made by what? A resident person and what? A permanent establishment of non-resident person. The case here is a resident person. You know, I said we have individuals and so unless that individual is designated as a withholding tax agent, individuals generally are not. All right. So please take note of that. So by means the person making the payment and the permanent establishment of a non-resident person. So here we are talking about an entity, which is a resident, and the same entity, which is of for or a non-resident person. So that is that. Then we talk about the withholding tax base, calculation of withholding tax. Withholding tax shall be computed on the gross amount without deduction of expense. And here, I think this has been amended, and I need to brief you on that. It was amended in 2018. So I'll have to, this practice note, I guess, was issued in 2016, but there has been an amendment. All right. And so we'll look at that. So the tax base shall exclude of any VAT, all right, or communication service tax. And so look at this. Now, this is the new system you have to know. So you have gross amount. Then normally you charge NHIL, right? And get fund, which is 5%, because it's 2.5, 2.5, making 5% on this amount. So you get this. Now there has been introduction of COVID. So there is another 1% on this one. So you have to add. When you add all of them, you get what we call a taxable amount. Then on this taxable amount, you charge VAT. VAT this year is 15, but for the purpose of your exam, depending on the date of the question, last year, VAT was 12.5. So please take note of that, depending on the question. Always check the date of the question, because you cannot apply a 2023 tax rate to a 2022 transaction. All right, so please take note of that. Be very mindful of this in the exam. So this one, when you do it, you get your amount, and this is the amount payable to whoever rendered the service for you. Now, you see here that they said that contract sum is this, you less VAT, NHIL, the exclusive amount is what you are doing the withholding tax on. But now it has changed. It changed in 2018. So depending on the date of the question, just be careful. If the question is from 2018, I think it was in August coming, which I think basically your exams, since we are in 2023, your exams date is normally 2022. All right. So, and when a law comes, it takes one full basis period before it's applicable in your exams, according to the directive of your exams. So now what happens is that this money becomes the taxable money, and it is the one that you will charge either the 7.5 or the 3% on. So this is the amount that the withholding tax is charged. So be very, very careful in the exams. All right. Be very, very careful. All right. So because of that, I'll jump this example because it's not applicable. See, the only thing is that it should be exclusive of VAT, not NHI will not be part. Exclusive of VAT, not NHI. All right. And so the due date for filing is 15 on or before the 15 days after the end of the calendar month with the tax applies. So what we are saying is that currently we are, let's say in April, right? So by May 15th, you should file and pay the tax for the monies that you withheld on this one, on April. All right. So please take note of that. So that is what you see here. For March, it will be 15. So take note of that. So that is the same for the filing. Okay. So when you are filing, these are the information that you need. I'll pull up the form for you to see how it works. So now, withholding tax agent who has no withholding tax obligation for the month shall still file. So don't say you didn't withhold anything from anybody, but you file a nil. I'll show you how this one too operates. All right. And once you file, you receive a credit certificate. All right. So these days, the system has changed a bit. In the olden days, when you file and you pay, you receive a certificate. It has some orange and I think orange color, and you tear it into two when you receive it from the GRA. You keep one in your office, and you actually give it to the person you withheld from. You give it to them, but it's good you make a photocopy that when they come and collect, they sign. So you will give it. What you do is that you give the certificate to them, and when they receive it, they will now tear it into two. It has a line, a line that you can fold, and I wish I had it. So you will tear it, and once you tear it, then you will keep a copy in your office, and you compile all the others, do a nice Excel template schedule, and fixing all the numbers, the amount that was withheld. Then you will take it to GRA for them to credit your account. But these days it's automated, and so I'll show you how it is done these days. Because these days, when you are doing it, you put the tin of the person you withheld from. And once it is done, automatically credits the person. All right. So these days, you don't go to GRA for a paper certificate anymore. You can print it in your office. So I'll show you, I'll use an example to show you that. So it says that withholding tax, that's the credit certificate. So we have the withholding tax certificate, all right? That shows that you have actually paid, all right? Then we have tax credit certificate, which is not final. It's regarded as having paid the amount withheld, all right? Uh, so note that. It says there that in partnership, the tax deducted on payment made to partnership shall be allocated to the partners in proportion. So if a partnership rendered a service for you and you withheld and you are paying them, you pay to GRA. What will happen is that, partnership, it is the individuals that are taxed. Partnership are not meant to pay tax. The partnership as a business don't pay income tax. all right, but it is the individuals. So the tax that you withheld will be distributed among the partners in proportion to their profit or loss sharing ratio, all right? So that is that. Then we talk about obtaining withholding tax exemption, which people need most. But there is a condition you need to fulfill if you want that. You always apply to Commissioner General for such, but you have to have a good record, a satisfactory tax record, and the Commissioner General may exempt that supplier from withholding. Do you remember when we were discussing the powers of the Commissioner, that which is only delegatable to any of the three commissioners? We mentioned that power to exempt a person from withholding tax. That is the one that we are discussing. So you register, and registration is very key. So it says that under the listed condition must be met to qualify for withholding tax exemption. So we also talked about registration when we were dealing with what do we call it? Tax administration, all right? So that is that. Then the taxpayer must be registered for all relevant taxes administered, including what? VAT, unless it is exempt by law. So what it means is exempt by law. We will look at that when we are dealing with VAT. And you must have a team. So shareholders, employees, and directors, 10, all right? And here is something that you have to chop off. It says taxpayers in large taxpayer office should have been registered and filed their returns. These days, it's no more LTO, it's any tax service center. By your business record, you must have a proper accounting system in place. And here, what we mean is that it says that the taxpayers must have submitted notice of particulars of contracts entered to with non-resident. Do you remember we talked about that? You have 30 days to inform the Commissioner General of all these things. And recovery of non-compliance provision disqualify taxpayer at least 12 months, all right? So submission of all tax returns on due date. Apart from the withholding tax, you have to submit all your filing. This one means that you are a good taxpayer, all right? And even your directors, your employees, your expatriate staff. In assessment, we are talking about self-assessment estimate. You that is requesting for withholding tax exemption, do you do yourself? If you're under self-assessment estimate, it means that you have submitted the estimate for that year, and normally you have paid it up to the quarter you are requesting for the exemption certificate. If you are under provisional assessment, it means that Commissioner General has done it for you and you have paid. The tax payment by due date, I mean, we've already spoken about that. You have the table and the due date. Audit. So it means that the taxpayer should have been audited for. So if you have not been audited for at least the 3 years, in addition to repeated infractions of provision, so it means before they can even give you the withholding tax certificate, they must have audited you for your previous 3 years. Is that what is being done in these days? This is the law. I mean, fortunately, some senior revenue officers, GR officers will take money and they'll give out the exemption certificates. And these days too, you know that it's very difficult. It's hardly do we talk about dishonest checks anymore. But if you had a check dishonest, you are disqualified from being granted an exemption for withholding tax. So these days, Ghana.gov, I mean, you pay. So that is that. If you default in payment, and these days hardly is this one to see. If you default, then it's an issue. All right. The last thing we want to talk about is the taxpayers must have submitted list of particulars of all payments which would have suffered withholding tax, but for exemption at the end of every year, every calendar year. All right. So those that you didn't exempt from, for example, if you conducted an exempt supplier, you were paying an exempt supplier and you did not withhold because the person was an exempt. You have to furnish the Commissioner General with the list of those ones that otherwise you would have deducted withholding tax, but just because of the exemption, you didn't. So that is that. Then the last thing that we want to discuss is it's a third party, discovery of third party information undertaken by a taxpayer which are not included in the taxpayer's business or financial statement. Disqualifies the taxpayer for at least 12 months, all right? This is all in the name of getting withholding tax certificate. A taxpayer shall demonstrate that should demonstrate that suffering withholding tax would lead to cash flow. Before we can give you the exemption, you have to tell the Commissioner General that, please, I'm applying for this exemption because the withholding tax that I'm paying is affecting my cash flow and my working capital before the exemption is given. But I don't think these days they do all these things. All right, so that is that. So all application for exemption for withholding tax should be submitted at the taxpayer's tax office, stating the projected turnover for the current year and the chargeable income and the projected tax for the year. So that is the, you see this thing is issued in 2016 by Kwesi Jima Asante. The current Commissioner General is Reverend Dr. Amishada. So that is that. What I'm going to do is to pull out the withholding tax form that you fill for practicality purposes. So the form, the withholding tax form, so that I'll show you the practicality of it, so that it won't be like you are just learning theory. All right. So this is the withholding tax form. Just a second. I'm downloading it from online. All right, so this is the withholding tax return form. So you come here. So you have your tax office, TSC. Like I said, if it is Nungwa or wherever you are, Tema, you put it there. Then the month. So if it is April 04/2023, then the name of the company, then the TIN or Ghana card number, put there. So that is if you are, remember the tax law says that a resident person and the permanent and establishment for a non-resident person. All right. So the resident person can be grouped into uh, uh, individual, but like I said, so for example, if I go to the market and I'm buying things that is exceeding 2,000, you don't expect me to withhold tax as an individual. I mean, so individuals, unless there is a peculiar case for you to withhold withholding tax. So please take note of that. So what you do is that uh, the person that you are doing the job for, you see the person that is doing the job for, is he a resident or a non-resident person? You select. Then the Ghana card number you put there, or the thing you put there. Then the name of the taxpayer, the location of the business, the contract sum. So please be careful. Here we are talking about the contract sum, the full amount, the transaction price. All right, because you may be paying parts, not all the amount. So the part that you are paying is what will come here. Then the withholding tax type. All right, is it a good? Is it, so when you pick a good, it automatically selects the tax rate. You see, all these things are here. So let's pick works. Automatically, it gives you 5%. Are you see? So let's see. Do we have non-resident entertainer or payment? 0. Interest, it should pop up automatically. Dividend, 8%. See, so that is what they are working on. Management of technical service is supposed to be, if it is because I selected a resident person. See, you see those. So if you come here, you select non-resident person, for example, you see it has changed to 20%, like I told you. All right. So these days, they are making things simple. And so you realize that some of these things you are learning, uh, so interest, let's me go to a resident person. So you see some of these things you are learning, you have to be careful, because if you are doing it and the tax rate is wrong by default from the GRA, then you can query them. Have you seen? All right. So that is what we are talking about. So rent, you see non-residential is 15. But do you remember what we said about rent? If the person is conducting a business of a let-off and that, you see that one had to revert the thing to 7.5%. So you have to be careful. Director's fee is 20%. So commission to insurance and all those things. So once you do, let's say if I put the contract amount, let me say 50,000. And the amount I'm paying out of is 10,000. You see, it shows the tax to be withheld. All right. So that is how the system works now. All right. So you fill all these things, as many as it has to be. All right. So you fill all these things. Then the total will shoot there for you. All right. So that is how it is. And you see, initially you have plenty things over here, but these days when you are done, you are going to upload it. Okay, you are going to upload it on the Ghana.gov. Let me see if I can demonstrate. Okay. All right. Since I still have, I still have So let me use. All right. So just because of class purposes. All right. So you see what you have here. Okay. So this is a provisional assessment. So withholding tax, if you finish, you want to file it, you want to see file. All right. So these ones are there not done. You see the number of days, it is there for you so that you know these people have not done their uh, provisional assessment. So I think the Commissioner General has done provisional assessment and has put the amount there. You saw it. So if you saw, this is what the Commissioner General has done, and you are supposed to pay every quarter, pay some. All right, so that is that. Let's see, I want to file withholding tax. I think they filed it already because 15th of this month has passed. The ones that has been filed, you see withholding tax for April's own will be due in May. In April, they filed this. So you could see the filing that has been done. All right. Unfortunately, the company, I don't want you to see. So if it is nil, they filed nil. All right. So that is that. So please, that is how it is. If you have something to file, then you can upload it. So there is a space for uploading. So that is what you do. All right. So that is how withholding tax operates. So uh, well, this brings us to the end of our withholding tax class. All right. So let's meet another time to discuss a different topic, maybe the tax administration, or move on to personal income tax. All right. So thank you very much and have a great day.